Hello friends, welcome to yet another episode of SaaS Growth. Today we are going to talk about something less glamorous but something which is really necessary for SaaS growth, which is finance and accounting. Well, today's CFO is unlike any other of the past or unlike any other business. Today's CFO of any SaaS business is responsible for a healthy growth of the company and even when it comes to strategic initiatives like mergers and acquisitions, investments, and even overlooking day-to-day growth. On that note, I'll quickly share what we're going to talk about today. We're going to talk about SaaS revenue principles, expense management, customer lifetime value and CAC. In addition to all the metrics that I've just said, something that is really required, financial reporting and compliance. On that note, let's start. Let's talk about the uniqueness of SaaS accounting. We're talking about recurring revenue and deferred revenue over here. When I say recurring revenue, it's very quick to imagine that over the period when you take a SaaS subscription, you consume the subscription over a certain period. You may be paying upfront, but you do consume over a certain period. Now let's think about it, how a SaaS accounting professional will tackle with it. It requires a different approach. What it requires is that the revenue is recognized and recorded at the time of the delivery, not really on cash basis. It's not like that you paid the money today and it was recorded for the entire subscription throughout in the books. What it does mean is that there is a deferred revenue for the SaaS company, which must be managed very carefully to reflect company's financial health accurately. Revenue recognition principles. This is essentially accrual versus cash basis, which we just spoke about. And there are performance obligations. When I speak about performance obligations, think about it that you have the access to the software over a certain period of time, and that is the contract which is satisfied for the company to recognize revenue over the period of that tenure for sure, not instantly. And that specifically provides a good outlook to the overall financial health of the company. Expense management in SaaS. Think about cost of goods sold. When we say cost of goods sold in a SaaS perspective, we're talking about software development cost, customer support cost. There will be other additional costs as well, like sales cost, marketing costs, admin cost. All of it needs to be in line with the revenue that is projected, that is recognized, and that actually materializes. Customer lifetime value. Customer lifetime value is essentially a metric which more than often is considered by RevOps people. But in 2024, RevOps closely associate with the CFOs also in a company, and that can be seen as a vital information, because customer lifetime value essentially means what a customer is providing in the overall lifetime that they stick with. When we talk about customer acquisition cost, it means all the sales and marketing efforts that have been dialed in to get that customer on board. And obviously you would want your customer lifetime value to be more than customer acquisition cost. Everything needs to be in check, and everything needs to be envisioned upon by the CFOs of today. Financial reporting and compliance, extremely important. SaaS companies adhere to various accounting standards, but the most important ones are ASC 606 and IFRS 15, which govern revenue recognition and financial reporting. Transparent recording is the essence of investor trust, of stakeholder trust, employee trust, and it really reflects how your financial statements, performance metrics, and disclosures are handled. Having said that, as SaaS companies grow, it should not mean that your cost of accounting or the cost of running FinOps should also increase. There are ways out there that the two things should not be correlated in the increasing fashion as you go with it. What I'm saying is that as your SaaS company grows, it shouldn't be that your accounting cost and then finance cost grows at the same pace. It would grow, but should not be at the same pace. Otherwise, it would be yet another cost center adding to the burn rate of the overall company. Until we meet next time, this is Kanav Jain signing off.